Let's do a quick recap. After seeing that triangular equilibrium makes currency markets truly random on lower time frames, we learned not to trust candlestick charts the way you might with other assets. We have learned to accept that there won't be a perfect entry. Due to this, we will need a rough idea when to enter, which we discuss in future lessons. We also know we can utilize large studies from multiple Ivy League schools that show using a multiple of the average true range, typically 3 to 5 ATR for stop loss, is ideal. In short, we compensate for the randomness by using math to determine where our stops should be. From there, we did a deep dive into the various market participants. We found something interesting. Even though we trade the spot market, we don't want to rely on spot data because the spot market is not centralized the way futures are. We do not want to take the volume or candlestick movement provided by our broker with any real consideration. I want you to pause for a second. Those few points already put you ahead of most Forex traders. You can now see why some argue Forex is truly random. Between price being able to move without any volume behind it through triangular equilibrium and knowing that your broker's volume may differ from mine, we can't rely on that information to make informed decisions. We are beginning to separate you from losing traders. And the best part is we are just getting started. Let's make today's lesson a little easier to understand. Today we talk about the different sessions. There are 8 major currencies that represent about 86% of all currency transactions. Of those 8, all of them transact primarily in only 4 different sessions: the Tokyo session, the London session, the New York session, and the Australian session. Knowing this, we can begin to make some more progress. You see, the banks are responsible for most of the transactions. If you recall from our previous video, it's specifically the bank's dealing desks that do most of the work. Imagine you are a large business in the United Kingdom and you buy products from the United States. You'll call up your bank and say, I need to buy 50 million of these products from the US. Your bank will then quote you their best price to do the transaction. This price is typically 200 to 600 pips away from the current price. The bank will profit the difference and pay part to the trader. These transactions have a heavy influence on the market. But think about what I just said. It's the bank trader's job to be at the bank at 8 a.m. when the desk opens. So it doesn't matter what country they're in. That gives us a massive clue on what hours to trade which pairs. It should be obvious, but trading USD and CAD would be most beneficial between 8 a.m. and 10 a.m. EST, which is when these traders start to move large orders. 3 to 5 a.m. EST is the London Open, so we would look to trade EUR, GBP, and CHF pairs. This makes sense because the London traders would start to make big orders in the London session and so on. The pair you trade should line up with the session you trade in. This is one of those pieces of information behind the charts. Even though the average person doesn't see it, it's there, influencing our trades and our potential outcomes. I'll have more details on the information behind the charts in future videos, which will help you understand why you give 2 traders the same chart and one does massively well and the other blows their account. It's because it's not the charts. It's the information you have to work with and the trader's development. Most people want trades to take off in the direction they placed a trade, but how many of them focus solely on the first couple hours of the trading day? Not many, but this simple decision means more of your trades will go in your favor. For today, we will keep this video short. I hope you've enjoyed the start to this video series that will transform the way you trade currency. In the meantime, Make sure to like, comment, and subscribe. It really does help out the channel and shows me I should keep going with this content.